Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. The weekly key reversal up, constructed 2 weeks ago, is still reverberating in this market. Prior to this construction, 4 weeks ago, the market dropped to flirt with the May 2011 high at 27,330 and approached the slowly rising medium moving average, currently 28,080. Under this medium moving average was a fairly free zone that stretched down to the August 2011 high at 25,195. 3 weeks ago, prices pushed down below the medium moving average into this free zone, but suddenly jarred to a halt at the round number of 26,000. After 2 weeks of testing this level, prices gave up on the downside and subsequently created the weekly key reversal up. In the process, the market broke back up through the medium moving average and also the significant late March to date downtrend, currently at 25,425. This downtrend will be retired after this commentary. What was significant about this downtrend was that in its short time of existence, it managed to become a three-pointer. It also showed the bearish angle of attack since the time prices started to calm down. It was the breaking up over this downtrend Thursday and Friday 2 weeks ago that I suspect may have caused the weekly key reversal up and the subsequent shooting star pattern type 1 bearish. I will now expand on a theory I have about why the market halted in the 26,000 area when there didn't look like there was any sizable support there. I laid out the basis of it 3 weeks ago and repeated it over the last 2 weeks. I think it's appropriate to repeat it here again today. You see, the August 2011 high at 25,195 is an interesting level. Other than just the fact that it was a significant high in the past, it was also the approximate start level from where we had the original huge rally in March and the subsequent ghost highs. Hence, we will be back where the market started, way back in late February. And it is the market's approach to these levels that has prompted a premeditated response at a higher level. Indeed, at the next higher round number level of 26,000, in anticipation of the 25,195 level being tested. Since this very recent move higher, the market has started to construct a possible bull channel, even an ascending wedge pattern, currently 28,135 to 31,625. Interestingly, the lower trend line is currently aided by the rising medium moving average, currently at 28,080, and the upper trend line just had the short medium moving average pass down through it, currently 31,185. Another additional feature is that we can now regard the May action as a double bottom. Hence, a primary upside target X would be in the 3950 area, whilst the harder to achieve secondary target X1 would be in the 32,000 area. Target X came very close to being reached last week when we had that shooting star pattern, bearish type 1. However, I'm not satisfied that it had reached it, so it will remain a live target for now. LME 3-month zinc. There is once again a lot of interesting things going on here right now, some of them contradictory. First of all, I'd like to set the context. I'd previously spoken about how I had on occasion taken a step back and looked at the monthly charts to get a better picture. From these I noted a significant pattern still in operation plus a second pattern that was forming. The principal pattern was the 2015 to 2020 bullish Andrews pitchfork. The most recent events evolved this pitchfork. 4 weeks ago, the market moved down through the middle time, currently at 39.54, dropping down to the rising long moving average, currently 35.56, and kissing the lower trend line, currently 34.95, of a very large ascending expanding wedge pattern, where the market virtually immediately reverted back up again. This action refers to the second pattern, the previously mentioned one that is still in formation and also in operation. First, it would require you to ignore part of March's action. Thus, we have the 2020 to date ascending expanding wedge pattern, currently 34.95 to 47.50. This is a very, very important pattern, as I will shortly show. The subsequent recovery all the way up to the combination last week of the very recent 50% Fibonacci line at 39.96 and a flatlining short medium moving average, currently 39.99. Well, this capped the rise for now. Thus, it seems for the moment that the market is capped overhead by the short stroke medium moving average and the 50% Fibonacci combination, and supported below by the long moving average. The former is currently going sideways and the latter is very slowly going upwards. The recent move up and now down still has some other, in one case, larger forces impacting prices. The larger force is the optimized May 2020 to date uptrend, currently at 37.92, which is giving an overall bullish aspect to the market. Almost a slowly rising bullish angle attack, if you will, even when it has been breached. The second force has not really been tested as yet, though it has seen some market action. Even then, I'm still not sure if it is a valid force. It is the prospective March to April bearish shift pitchfork. This pitchfork has not had either the upper or lower time tested as yet, and until it does, it will remain prospective. The one time it has seen action and has seen an inconclusive response as a result is the middle time, currently at 35.93. Overall, this market seems for the moment to favour the 2020 to date ascending expanding wedge pattern as its main driver for now, which is a very wide range within which a lot of things can happen. Finally, let's look at ascending expanding wedge patterns on their own. Well, for starters, they are usually not bullish. Just over half of the time this pattern ends up with a bearish break lower. However, if the price breaks upwards, the quality of the move higher is usually seen as better than any break lower. We are far away from testing the two trend lines on this pattern, and way too early to start talking about any targets. However, as we seem to be with the short, medium and long moving averages to be in a pattern within a larger pattern, I thought you ought to know these things ahead of time, just in case. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.